Hello everyone, good evening. I, CA Jitesh Dula, would like to welcome you all to today's webinar on accounting standards applicable to non-corporate entities, organized jointly by Amravati branch, Ahmednagar branch and Jalgaon branch of WIRC of ICX. To take us through this important topic, we have an eminent speaker with us today, CA Shraddha Khetsara ma'am from Mumbai. Welcome ma'am. I would also like to welcome the chief guest of our today's webinar, RCM, CA Saurabh Ajmera. Now, I would request CA Pawan Raju sir, chairperson of Amravati branch, to give welcome remarks.
First of all, a very good afternoon to our regional council member and branch nominee, CA Saurabh Ajmera sir. We have with us today's eminent speaker, CA Shraddha Khetsara ma'am. We have with us CA Pawan Kumar Darak sir, chairman Ahmednagar branch. We have with us Vicky Bhai Birla, chairman Jalgaon branch. We also welcome executive committee of Jalgaon, Ahmednagar and Amravati. We have our Amravati executive committee also here. And all the participants, a very good afternoon. Today we have session on accounting standard. अकाउंटिंग स्टैंडर्ड जैसे मैंने अभी बोला कि भाई जैसे जब सीए सिलेबस के बाद में बस अभी पढ़ने का काम पड़ रहा है और जब सेशन होते तभी पढ़ने का काम होता है, खुद होके कोई मुझे नहीं लगता पढ़ता होगा. सो दैट्स व्हाई दिस इज वेरी इंपॉर्टेंट and consequences of not following accounting standard are very risky. So for learning accounting standard, to master the accounting standard, we have with us today Shraddha Khetsara ma'am, and very well planned and need of our topic is this. So I request all the participants to please be attentive and ask as much queries as possible. You can type your queries in the chat box or you can ask at the end of the session to our today's speaker. So let's start with the session. Over to you, Mr. Thank you, one and all.
Thank you, sir. Now I would request RCM CA Saurabh Ajmera sir to share his keynote.
Sir, you are on mute, sir.
Thank you, Jitesh. First of all, I like to congratulate all the branches, Ahmednagar, Jalgaon and Amravati, to organize such a wonderful program, which is need of the hour also. When we are discussing about the accounting standard, we always have a thought process like this is applicable to the corporate entities to a specified extent. But this is the thing today we are discussing for non-corporate entities. And it is very well relevant topic for today's scenario, in which the classification is also important, which came out on 31st March 2021. Apart from the classification, when as an auditor, we are going to sign notes to accounts for non-corporate entities, it impact a lot for the notes parts. So that will touch by Shraddha madam. I will not go in detail, but I like to thank all of you to organize such a innovative programs. And I like to suggest some of the programs which also can be organized for the benefit of the members. Like some networking summits, we can organize faceless assessment and overseas opportunities with overseas chapter we can plan, and that will be very useful for our members of all the branches. As far as concerned regarding the WIRC, I am heading startup committee chairmanship, valuation committee chairmanship and MSME also. So we are organizing on a monthly basis specific valuation programs which are completely on the basis of practical aspects. We are also planning to have a 15-hour refresher course in the June month related to the startup journey from an idea to IPO. How an idea can be converted in a startup and then angel funding, other investment rounds and IPO. So it will be covered in our reference course. Same way in valuation also, we are planning stress companies valuation in a different way, early age companies in a different way with the practical walkthrough. So I like to suggest all the chairmen, please go on a practical note, how we can do some walkthrough also, so our members can be equipped in a practical manner. So this is the thing which we can implement while doing the joint program. We can have overseas joint program also, like UAE is coming with the corporate tax. And it's a huge opportunities to have outsourcing work for our members. We can connect through networking our members in UAE, and then backup can be planned accordingly. So this is my thought process for all of you. we can plan in such a advance in November or December. Corporate tax will come in UAE, but we can plan in an advanced manner. So here I like to thank all the branch, Pawan Jajuji, and all the team of Amravati branch, energetic team of Amravati branch, and Pawan Darakji, chairperson of Ahmednagar branch with energetic team, and Vicky Billaji, chairperson Jalgaon branch with all the energetic members. Thanks a lot for inviting me, and I hope you will all get benefit in terms of knowledge sharing through Shraddha Madam on such a very, very important topic. Thank you, everyone. Over to you, sir.
Thank you, sir. Now I would like to call upon CA Pawan Darak, sir, chairperson of Ahmednagar branch, to give opening remarks.
First of all, I welcome Shraddha Madam for this, for accepting our invitation and for this webinar. I also welcome Saurabh Ajmera sir, and thank you, sir, for suggesting us various innovative programs. Definitely, we'll be working with WRC for these programs, as you are the chairman in some of the committees. It will definitely help us, help all the branches, obviously. Yeah, I welcome all the participants for this nice program. Friends, as you are aware, most of us believe that accounting standards are for the corporates. This is general tendency. Though we are chartered accountants, we are well aware. But the thing is that this is a general tendency. The accounting standards, most of the accounting standards are applicable only for the companies. But this is not the case. Many accounting standards are equally important for the non-corporate entities. And being a chartered accountant, we must comply the same. So with this intention, we, Ahmednagar branch, Amravati branch and Jalgaon branch together decided to take this program. I wish you all the best, and I wish you all the happy learning. This program will definitely help you for your professional practice. Thank you. Over to you. Yeah.
Jitesh bhai, I have to make one announcement.
Yes, sir. Go ahead.
Saurabh sir and Shraddha ma'am, we are planning on 26th. We are planning a physical program on VAT amnesty scheme and income tax assessments, section 148 and that. And then we are also planning non-technical three-day workshop, non-technical subject like professional protocols, professional etiquettes, and personality development and stage daring on 29, 30, and 1st. This is a non-technical event, and this is in physical form at branch. Thank you.
Thank you, sir.
Thanks for the update, Pawan bhai. It's
Yes,
really very, very important topic again related to VAT amnesty. So my best wishes to all your branch members.
Yes, sir. Thank you, sir.
Thank you. So now, before we begin our technical session, I would like to give a brief introduction of our today's speaker, C.A. Shraddha Khivsara ma'am. Ma'am qualified as a chartered accountant in the year 2008 and thereafter as a company secretary in the year 2009. She also holds a diploma in IFRS from ACCA UK. Ma'am has a work experience of over 12 years in conducting statutory audits of companies in multiple industries like automotive, manufacturing, engineering, renewable energy, IT, and IT-enabled services. She has conducted statutory and tax audits of numerous listed, private limited, public limited companies, as well as MNCs, and has an in-depth knowledge of Indian GAAP, Ind AS, and IFRS. She has also led various Ind AS implementation engagements for her clients. Apart from this, she has also imparted various training on Ind AS, accounting, and accounting standards. Ma'am, given your versatile work experience, I'm sure we all would learn a lot from you in this webinar. So now, without much further ado, let's hear from you, ma'am.
Yeah. Thank you so much, Jitesh, for that warm welcome and those very nice comments. So let me just share my screen.
Yes.
Then we will. Let me just know once my screen is visible.
Yes, ma'am, it's visible.
Yeah. So a very good evening, all of you. So my dear friends, I think in the opening remarks, all of our fellow colleagues and the branch chairmen have highlighted the importance of accounting standards. So today's topic, again, I would like to just mention that today's topic is extremely important A lot of us have the tendency to think that accounting standard is something which is applicable to large listed companies, private limited companies. My client portfolio is largely of sole proprietorships, trading firms, partnership firms. So I don't have to do anything with the accounting standards. So as Pawan mentioned, hello.
Saket bhai, can you please mute others? Except speaker. Yes,
Madam,
ma'am, please.
Mute mode.
Yeah.
Shraddha ma'am, your screen is not visible as of now. Now you are starting. Oh,
I think it would be visible now.
yes.
Yeah. Okay. So as already there was a lot of emphasis on accounting standard, I think, yes, it is very, very important for each and every professional, for each and every member of institute to understand the requirement of accounting standards, as these are not only applicable to large companies, but these are also applicable to non-companies. Yeah. So these are also applicable to non-company entities. So what are we going to do today? Today, we are going to discuss about the applicability criteria, various exemptions which have been given by the ICAI when they came up with a circular in the council meeting in March 2021. And then we would also discuss about few accounting standards, practical challenges which we as our members would face when we would be auditing or conducting the tax audit for our client on key accounting standards like AS2, AS9, and AS10. So that is what we are going to discuss in next 2 hours. Before we move or dive deep into this topic, any guesses? Anybody would want to guess how many set of accounting standards are there in India? You can type on the chat box as well. How many set of accounting standards are there in India? No guesses? No messages on chat box? So considering there is a silence here, I would tell you technically there are 3 set of accounting standards. Okay. Practically, I think Jitesh has mentioned to say accounting standards and Ind AS. Yes, it's a right answer. So practically there are 2 sets of accounting standards. Technically there are 3 sets of accounting standards. I'll tell you how it works. Accounting Standard Board, which is board which I would say issues accounting standards for on behalf of ICAI. Accounting standards are issued by ASB and then issued by ICAI, which is an ICAI board. Then there are a set of accounting standards. So section 129 of Companies Act mandates companies, okay, to have a set of accounting standards, to follow a set of accounting standards while preparing the financial statements. So there are separate set of accounting standards which are notified by central government, okay, which are applicable to companies. Now, practically, the accounting standards which are issued by ICAI and the normal accounting standards which are notified by central government, those are one and the same. So we loosely call them as accounting standards. And then there's one set of another standards which we call as Indian accounting standards or Ind AS, which is an India version of IFRS standards, which is applicable to large companies like companies having net worth of 250 crores, so on and so forth. So from a practical aspect, you can keep in mind there are 2 sets of accounting standards and Ind AS. So in our today's session, we are going to discuss about accounting standards as Ind AS is not relevant for non-corporate companies. So how would you define NCE? What is an NCE? What is a non-corporate company or what is a non-company entity? Any guesses? So as most of our client falls into proprietorships, partnerships, trading concerns, trust, AOP, all those are nothing but non-corporate entities. There is no regulation or there is no definition, one definition of non-company entities or a non-corporate entities. You can loosely say whatever is not a company or whatever is not registered under companies as a company would largely fall into a definition of non-company entity, which will include all your client types like partnership firms, LLPs, HUFs, cooperative societies. One may question why LLP is a non-company entity. So if you go by the definition of LLP, it's a body corporate. Okay. If you look at the beauty of the circular, which was issued by this Institute of Chartered Accountants of India, though we loosely call it as non-corporate entities, the circular uses the word non-company entities. So non-company entities, LLP is not a company, it's a body corporate, and hence LLP will also fall into the definition of NCE, and these standards would also apply when you would perform the audits for LLP or when you would be doing the tax audits for LLP. Okay. Let's move to next section. Under which regulation or legislation do you think non-corporate entities are required to follow AS? So today we are all discussing about accounting standards being mandatory to these non-corporate entities. Tomorrow you go to your client and tell him that you need to prepare the financial statements considering the accounting standard requirements. Your client may come back and say, Mr. Chartered Accountant, I am a sole proprietor. Which regulation or which regulator requires me to follow this accounting standard? What would be your standard answer to this? So largely he is right to say, I am a sole proprietor. There is no regulator which binds me. There are different regulations which I am required to follow. Under which regulation do you think, or under which regulation, please quote me that regulation that I need to prepare my financial statements following the accounting standards. So to answer this question, my dear friends, in next few slides, we would be discussing about different aspects because of which following accounting standard becomes extremely important and critical for we as members when we would be carrying our test functions. So hold on for this question. There are various requirements because of which you are required to follow these accounting standards while performing your attest functions. Now let's think about preface to the statement of accounting standard. What is this? So accounting standards were issued long back. Okay, when accounting standards were issued, there was preface to the statement of these accounting standard. What does that preface talk about? If you look at the preface, it says the accounting standards will be mandatorily applicable as mentioned in the accounting standard. So date of the applicability will be mentioned in a respective accounting standard. What does that mean? The mandatory status of the standard means that while you would be discharging your attest function, you as a member, we all as a member of the Institute of Chartered Accountants of India will be duty bound to verify, to examine whether the financial statements which are audited by you are in compliance with the accounting standards. So again, to re-emphasize, once an accounting standards become mandatory, we as institutes members, we are duty bound to ensure that the financial statements on which we issue our audit reports are in compliance with the accounting standards. What if those financial statements are not in compliance? We as a chartered accountants, members of institute, are required to bring about an adequate disclosure in the report stating that there is a deviation from the accounting standards. Okay, so in a simple terms, we need to modify our audit opinion to state that there is a deviation from the accounting standard compliances. This preface to accounting standard also says that these accounting standards are applicable not only for the general purpose financial statements, but they are also applicable for financial reporting, which are subject to attest function by the members. What does that mean? So tomorrow, say XYZ and Co. It's a partnership firm, which is your prestigious clients comes to you and say, sir, I need to take loan from bank. Bank has requested me to get last 2 years financial statement audited by the chartered accountant. Please issue an audit report. Please audit my financial statements. Now again, this is an attest function. You are doing an audit. So basically you need to ensure that while doing any attest function, the those financial statements are in compliance with the accounting standards. So the first requirements come from the preface to the accounting standards, which are issued by ICAI. Now let's look at the next requirement. We all are members of Chartered Accountants of India. All of us would have studied Chartered Accountancy Act someday to clear a final examination. So if you recollect, my dear friends, there was Schedule 2 to the Chartered Accountancy Act, which says that a member in practice would be guilty of professional misconduct if he fails to report a material misstatement, if he is found to be grossly negligent while doing his professional duties. So what does that mean? It means that in case there is a material misstatement which is not reported by an auditor. Now, what is material misstatement? Material misstatement again is defined in the auditing standards. So departure or non-compliance of accounting standard also falls into the purview of material misstatement as per auditing standards. So in case tomorrow in any of your clients, there is no compliance with accounting standards where we as a chartered accountants have not adequately disclosed that in our report, it could be a failure to report a material misstatement. It would be construed as a gross negligence while conducting our professional duties. Okay, considering the current scenario, we all are aware any financial debacle, any financial irregularities noted in any entities, chartered accountants are the first ones, the auditors are the first ones to be questioned. Considering all that, considering non-disciplinary committee, changes in the composition of non-disciplinary committee, my dear friends, it becomes very, very important that we become vigilant and start verifying the compliances with the accounting standards on all our engagements, on all our clients, on all our assignments. Otherwise, tomorrow, if there is a verification and it turns out to be a gross negligence, we could be guilty of professional misconduct. So those are really very, I would say, harming or very strict steps which an institute disciplinary committee could take in case accounting standards which are mandatory are not followed. Now you would say, I have been doing these audits, these tax audits for really long. Accounting standard, preface to accounting standard. Madam, what are you talking about? Institute of Chartered Accountancy Act, all this has been there for very, very long. Okay, Chartered Accountancy Act has been very old, preface to accounting standard has been very old. There is no change in the accounting standards. Okay, institute has just come up with circular. I have been doing my tax audits for really long year. I have been member. There has been no issues till now. But sir, recently, considering the again regulatory environment changes in the way there are expectations from auditors, Institute has formulated a board, which is a taxation audit quality review board. So most of you would remember that a quality review board was established to review the quality of large companies, public limited companies, considering keeping in mind public interest in those companies. On similar lines, Institute has went ahead and a taxation audit quality review board has been established. Now, what can this quality review board do? You would say my clients are largely small proprietors, partnership firms. They are not big companies. There is no public interest there. But sir, wait for a minute. Quality review board has been given powers where they can pick up any non-corporate entity and they can start reviewing the tax audits of those non-corporate entity. So tomorrow, one of your client may be selected by the taxation audit quality review board to verify whether the audit of the quality of the tax audit which was conducted by you was appropriate or there are any lapses. In case there are quality lapses, again, member may be considered as guilty of professional misconduct. Why do you think this quality review board has been incorporated and it has been given powers to pick and choose even non-corporate entities? So I'll share a statistics with you. Out of the total number of tax audits filed, approximately, I would say more than 95% of tax audits are filed in Form 3CB. What does that mean? So as you all are aware, when do we use Form 3CA? Form 3CA is used when audit is mandated under certain regulation. For example, Companies Act. Companies Act requires companies to do an audit mandatorily. So in case you are doing a tax audit of any company, you would report in Form 3CA. And then, so what does that mean? Audit was already conducted under Companies Act under some other regulation, and then you certify the tax audit. In case of a partnership firm, as there is no mandate, there is no separate regulation which requires you to do audit other than Section 44AB of the Income Tax Act, you would be filing Form 3CEB. So what are we trying to say? What is government trying to do? Out of the total tax audits filed, large number, very large chunk of tax audits pertains to these non-company entities or these non-corporate entities. And therefore, it becomes very, very important to have a quality check on the type of tax, on the quality of tax audits conducted by the members for these non-company entities. So there is a quality review board which has been established, and the results, they have the powers to pick and choose any non-corporate entity. They can verify the quality, they can report on the lapses. Hence, this becomes very, very important that on all our assignments, we start following compliance of accounting standards. To reiterate, this requirement or this council meeting was conducted in March 2021, and all this was made mandatory from 1st April 2020. So largely all tax audits which were completed for 31st March 2021 should have complied with all the requirements of the accounting standards which we are talking about today. However, in case any of you would not have done that on your clients, please take a note of it. For 31st March 2022, ensure all your assignments, all your tax audits are in compliance wherever required with the required set of accounting standards. Now, till now, we discussed about what are non-corporate entities, what are accounting standards, where it is written that we should follow, what will happen if we don't follow. Now, there could be a question whether non-company entity, which is not required for a tax audit, wherein a tax audit is not mandatory, it is not crossing that threshold, whether still AS compliance is required. Now, this is a very relevant question. Let's look at this case study. This case study talks about a very common scenario which you would see in real life on any of your clients. A proprietor is there who is again a client, comes to you that, sir, I need funds from bank. Bank has asked me to get an attestation from a chartered accountant of the projected financial statements. Okay, so the proprietor is running to you, coming to you, telling you, sir, I badly need loan. These are the projected financial statements of my business. Please attest and give me. Basis this, I will get the loan. What will you do? The question here is whether, now this is not a tax audit. Again, this is a non-corporate entity. Whether you will verify compliance of AS. Any thoughts? Anyone would like to answer in the chat box? Any thoughts on this? Jitesh, you would want to try? So again, nobody has tried to answer this. So I'll answer it for you. Yes, these are projected financial. So yes, I have received one answer from Vinod which says not required. So he's saying you are not required to comply with accounting standard because this is not a tax audit wherein you are doing any audit. So this is a simple attestation of provisional financial statement, so not required. So my dear friends, I will again take you back to the requirements of the preface to accounting standard. Any attest function, okay, which a member would be doing, member should comply with the accounting standard. Having said that, there is one more important aspect to this question. Whenever as a chartered accountant, you are attesting a provisional financial statement or a projected financial statement, there is a separate standard called as SRE 3400. It is examination of the prospective financial information. So if you go through that standard, it is a very important standard. If you go through that, it also asks a chartered accountant to report whether the statements are in compliance with the accounting standards. Okay, so when you issue a report on the projected financial statements, you basically work on the assumptions, underlying assumptions which are used by the proprietor to prepare those financial statements. And again, an auditor is required to comment upon whether those financial statements are in compliance with the auditing standard. So my dear friends, any attest function which you are doing, please keep in mind accounting standards becomes mandatory. So next, moving to the applicability of the accounting standard issued by ICAI. I think we already discussed that in March 2021 in the council meeting, this applicability was discussed, and it was made mandatory that all non-corporate entities should follow accounting standards to the extent applicable with effect from April 1st, 2020. Now, there was again a classification of accounting standards earlier before this notification came in. So one thing I would like to make clear here, there's no change in the accounting standards. Accounting standards remain as is. So what has changed? The classification or the applicability of the accounting standards to those NCE has changed. So earlier, there were three level of companies, or there were three level of entities, to so to say, level 1, level 2, level 3, which were classified as SME entities. Now, in the revised criteria, there are 4 categories: level 1, level 2, level 3, and level 4. So what has Institute done here is there are more categories which have been brought into, plus the limits which were there in the earlier requirements. Those have been increased manifold times to ensure that there is no hardship on the assessees or on the clients as well as chartered accountants while complying with these accounting standards. Level 1 entities are really large entities which are listed, banks, financial institutions, or there is a threshold of, I would say, turnover and borrowings. Those entities, there is no exemptions which are given. They are required to comply with all accounting standards. So as we mentioned, 4 categories are there: level 1, level 2, level 3, level 4. Those are now called as MSME, micro. Level 4 is called as micro, level 3 is small, and level 2 are medium size entities. Earlier, those were called as small and medium size entities. Now let's look at the criteria. So if we look at the screen, what has changed? The criteria has changed. So any commercial, industrial, and business entity, okay, having turnover in the immediately preceding financial year. So earlier criteria was turnover more than 50 crores. It used to be level 1. So there were n number of entities which were falling into level 1. Now that has been increased 5 times to say turnover more than 250 crore, only then an entity would fall into level 1, or there is a borrowings at any point in time which exceeds 50 crores. So any of these criteria are met, then it becomes a level 1 entity. Similarly, for level 2, earlier it was 1 to 50, now it has become 50 to 250. Similarly, borrowing limits has also been revised and increased. Level 3, again, there is an increase in the limits, and level 4 has been introduced. So basically, this will try, and this has been done to ensure that there is no hardship on the clients as well as the practicing chartered accountants. In addition to this, there are a lot of exemptions which are given, which pertains to disclosure requirements of the standards. So what I have done, considering the limited time we have, and we also want to focus on the accounting standards, I have made an annexure to this presentation, which can be circulated after our today's CPE session, wherein detailed level-wise, standard-wise exemptions are mentioned. To say AS2, what all exemptions can be taken, AS10, what all exemptions can be taken. A detailed annexure I have made, which can be looked into, which you can refer whenever you are working on any of your clients. So largely what we need to keep in mind, every year you need to check the limits. You need to assess whether your client is falling within level 2, level 3, level 4, where it is falling, and appropriately determine what all accounting standards are required to be complied with. Please keep in mind, turnover of end of immediately preceding year and borrowings at any point in time. So for borrowing, it doesn't talk about closing borrowing balance of a preceding year, because it was noted that in many cases there were huge borrowings during the year, but at the end of the year there were nil borrowings to avoid such requirements. So what have they done? At any point in time, if you have a borrowing limit which say exceeds 50 crore, the entity will fall into level 1. Now, there could be certain questions about, we spoke about these standards becoming mandatorily applicable. You need to follow this while doing your attest function. Now, a very common question which comes up is there any format prescribed for the financial statements of non-corporate entities? Because here we are not only talking about the financial state, the balance sheet, the P&L, but yes, we would be required to have notes to accounts, accounting policies in place, as the accounting standard needs to be, all accounting standards to the extent applicable needs to be complied with. So obviously there would be a question whether there are any format prescribed for the financial statements. So there is no format prescribed for the financial statements. Many people believe Schedule 3 formats are applicable. So Schedule 3 formats are not applicable to non-corporate entities, as those are specifically for companies. However, non-corporate entities can prepare the financial statements in a Schedule 3 format as a best practice, or they can prepare in any other format which is generally acceptable practice. That should be fine. To give you further guidance, WIRC has come up with a model financial statements for non-corporate entities. You can refer those model financial statements and ensure your client's financial statements are almost prepared in those formats, and proceed with the requirements. But the point which I'm trying to make here is Schedule 3 is not required to be mandatorily followed. There is no specific format which is prescribed. Now, another question which will come up is, are tax auditors required to verify compliance while carrying out tax audit? So I think large part of this is already we discussed, that while performing the audits, whether performing the audit, while performing the tax audits, whether while performing the attest functions, we are required to carry out. There's one more thing which we need to keep in mind. If you go back and look at the guidance note which is issued for tax audits, the guidance note which came way back in 2014, it says when an auditor opines on the tax audit report, the true and correct view of the tax audit report, there is a presumption that they have also verified the compliance of accounting standards. In addition to this, all of you would be familiar with clause 13, where we are required to report the departure between the books of accounts, accounting treatment, and ICDS. So basically a reconciliation is required between, and the adjustments are required to be reported between the books of accounts and the ICDS requirement. That again further indirectly implies that yes, accounting standards are required to be followed while doing tax audits under section 44AB. Whether financial statements of non-corporate entities should comply with AS or ICDS. Now, a lot of members in practice have this question, that when we do tax audit, we are doing it from the income tax perspective. There is already a set of income computation disclosure standards which is there. So financial statements should also comply with those standards. So no, my dear friends, financial statements are required to be in compliance with accounting standards. Income computation and disclosure standards are notified from the computation perspective. So financial statements will be prepared considering this AS, and there would be adjustments, or there would be, in case there are any adjustment between the accounting standards and the ICDS requirement, those are required to be reported in clause 13 of the tax audit, and those are required to be considered while computing the taxable income of the assessee in the income tax return. So financial statement should be in compliance with AS and not ICDS. Again, there's one very common question which says whether charitable institutions are required to comply with accounting standards. Any thoughts on this? A lot of us would be auditing the charitable institutions. Do you think we are required to comply with accounting standards, or are we complying with accounting standards when we are auditing these charitable institutions? So Jitesh says, yes, we are required to comply with the accounting standards while auditing the charitable institutions. Anyone else has a different answer? Anyone believes it is not mandatory or it is not required? So I'll take you back to the requirements wherein it was mentioned, the criteria of applicability of was mentioned to say commercial, industrial, and business reporting entities. So in case a charitable institution is not carrying out any commercial, any industrial or business reporting work, then accounting standards are not required to be followed. In case they are carrying out even a small portion of commercial activity, then accounting standards will be required to be followed. There is a detailed guidance on this again in the tax audit guidance note, which again echoes the same thing. In case even a small portion of operations of a charitable institution pertains to the commercial operation, then the accounting standard becomes applicable. Let's look at this case study. I think we already should have an answer for this now. Siddhi Vinayak Mandir, it's a trust. It's a non-company entity. We are auditing the trust. Okay, it's a charitable institution. Whether you will examine compliance of accounting standard while auditing the trust. So as we discussed, in case tomorrow Siddhi Vinayak Trust has any commercial activity, say for example, parking lot, they are collecting money for people, for the devotees who visit and who park their vehicles, that may fall into the commercial activity. In case that is the case, in case there is any commercial activity, accounting standard compliance needs to be verified. In case it's a pure charitable institution, then there is no commercial activity, there is no business activity which is carried, then compliance with accounting standard is not required. This is a snapshot of applicability and exemptions. So we spoke about accounting standard being applicable, different accounting standards being applicable to different level of entities. So in India, under accounting standard, we have 27 accounting standards which are there. Level 2 entities are required to fully comply with 16, level 3 with 12, and level 4 with 8. So you will see as the level of entity increases. So if it's a micro entity, only there are 8 standards which are required to be mandatorily followed. If it is a small entity, then 12, and if it's a medium size, it's 16. And for level 1, all standards are mandatory. Other than that, there are few exemptions which are available to disclosure exemptions, partial exemptions to these level 2, level 3, level 4 entities. So what we are going to do is we are going to see which are those 8 accounting standards which are applicable to all level of companies. Okay. So these are the 8 accounting standards: AS1, AS2, AS4, AS5, AS7, 9, 12, and 16. So largely these 8 accounting standards will apply to any level of company. So even if your client is falling within level 4, which is a micro entity, these 8 accounting standard needs to be complied with. Out of these 8 accounting standards, today we will have a quick recap of AS2 and AS9, and then we will also discuss about the practical challenges which we as an auditors, as a member of institute, would face while carrying out audit of these financial statements regarding the compliance of AS2 or AS9. Any questions till now? Please post your questions on chat box so that I can answer those. We can also take questions at the end of the session. Now there's one question. While explaining the eligibility criteria, I said you need to look into it every year, what level of entity your client would follow. So take an example. In the March 21, your client was a level 4 entity. In March, based on the March 2020 turnover. Now, based on March 21 turnover, your entity, your client has done really well and it becomes a level 3 entity. So what do you need to do? Whether you need to start complying with level 3 requirements. There could be a vice versa scenario as well. Your client was a level 2 entity. Due to COVID, the operations didn't do well, the client didn't do well, and the turnover decreased. And based on the 31st March 2021 turnover for this year, it becomes a level 4 entity. So can you start taking the exemptions which are available for level 4 entity? So to answer that, there are additional guidance which has been issued by the ICAI in the circular which they had issued, which says MSME whenever they are taking any exemptions, should bring about that fact, should disclose that fact, whether it is a micro, small or medium, and what all exemptions have been availed in the financial statements. There should be a suitable note in the financial statements. In case, suppose it's a micro entity and the client as well as you decide that certain exemptions client don't want to follow. So they want to follow, say, all the accounting standards except one or two accounting standard, then it says the client can opt to do so. However, in the financial statements, there should be a mention about what all exemptions have been taken. So in case a micro entity wants to say follow all accounting standard except AS 22, then it should mention in the financial statements that it is in compliance with all accounting standard. However, it has taken exemption for AS 22. Now, the two questions which we saw on the slide, what happens if there is a change in the level of your client? So there again, Institute has made it very clear, in case there is any change in the level of entity, okay, you need to monitor those changes for at least 2 consecutive years. So what are we trying to say? Suppose an entity was covered in level 1, it subsequently becomes level 2 or level 3. It can't directly start taking all the exemption or all the relaxations of level 2 and level 3. Okay. For 2 consecutive years, if it doesn't again become level 2, for 2 consecutive years, it will have to follow level 1 requirements. After 2 consecutive years, it is still falling under level 2 or level 3, then you will start applying level 2 and level 3 exemptions or relaxations. But for 2 consecutive years, it will still remain as level 1. Similarly, any level 2 or any level 3 becomes level 4. For 2 consecutive years, you will need to monitor it, and only then exemption can be availed of. Now, let's look at the another scenario. So now last year your client was level 4. This year it is becoming level 3. There it says you need to start immediately following the level 3 exemption. So this is a reverse case. Here level 4 exemptions were higher. Level 3 you need to have more compliance. So say in the last year AS 22 was not applicable. This year AS 22 deferred taxes is applicable. So what will you do about the comparative numbers? It says for the comparative numbers, you need not disclose the comparative numbers because the standard is applicable from the current period. So corresponding period or the corresponding numbers, comparative numbers need not be disclosed. Also, what you need to mention is again disclose in the financial statements whatever that the entity in the previous year was a level 4 entity, and therefore previous period numbers have not been disclosed. Please disclose that fact suitably in the notes to accounts. So clear, it says in case level 1 becomes level 2, wait for 2 years, follow level 1 requirements for 2 years. After 2 years also it is becoming level 2, then start taking those exemptions. We spoke about ICDS. So here today, we will be not having any extensive discussion about ICDS. However, I thought it is important considering we are talking about accounting standards to also impress upon the ICDS applicability. So ICDS is applicable to all SSE except for those individuals or AQF wherein there is no requirement to get their tax audit done. They are not crossing that threshold. Which are following mercantile system of accounting and where income is chargeable under the head PGBPA or income from other sources. So there should be income which is chargeable from business or profession or other sources. Only then ICDS can become applicable. So again, financial statement should comply with AS. Adjustments which are prescribed under the ICDS should be done while computing the income tax or while preparing the return of income, and those should be suitably disclosed in clause 13 to form 3CD. Now let's look at this example. This is a classic example of a partnership firm wherein a P&L statement has been prepared. So there are a couple of errors in these financial statements. What I would request you all would be, if you can spot any error in the financial statements, and if you can just type that on the chat box, so that we can just understand what is the error in this financial statements, and then this will form the basis for our further discussion on different accounting standards. So just quickly, carefully look at the P&L statement for a partnership firm and see if you can spot any error in this. So Abhishek says borrowing cost, but what exactly about borrowing cost? Yes, so Abhishek is mentioning borrowing cost needs to be capitalized. That's the right answer. It should be capitalized and it should not be disclosed in P&L. Priyanka says closing stock. Jitesh says forex gain has to go to other income. A very good answer. Forex gain is clubbed in sales. It should ideally go on other income. Closing short stock should be lower of cost or market price. So it is not market price, it is net realizable value. Yes. So few of the answers is cost or net realizable value. Yes. Any other error? So we spoke about sales. There is an error of forex gain. Closing stock, it is disclosed at market value. Borrowing cost, it should have been capitalized. Any other error anybody could find? Okay. So is interest under section 234B and 234C an extraordinary expense? Whether it will fall into the definition? So no, interest under section 234B and 234C, if you go back to the requirements of AS5 and check, it would not be an extraordinary expense. Okay, so it should not be disclosed. And again, that is an error. Anything around depreciation? So generally, we see that while clients compute depreciation even in the financial statements, because our focus is completely on the return and from the income tax perspective, depreciation in books is also calculated as per section 32 of income tax. So friends, this is extremely incorrect. Depreciation in the books of account should be calculated considering requirements of accounting standard 10. Earlier, there was an accounting standard which was AS6, which was then later on, I would say, revoked by the institute. So now there is no separate accounting standard on depreciation, but fixed asset accounting standard also covers depreciation aspect. So from the book's perspective, depreciation should be calculated based on the useful life, which is assessed by the management. Now those rates of depreciation, that useful life may be in line with income tax, but under income tax, what happens is we follow a WDV concept. Okay, similar concept can't be followed in books of accounts. So useful life or rate of depreciation may be same, but WDV concept is not permitted under the accounting standard. It is as per section 32 of Income Tax Act. So you can follow WDV method, but not the WDV concept. So depreciation in books should be computed based on the requirements of AS10 and not as per section 32 of Income Tax Act. That should be section 32 amount should be considered while computing the return of income. So that is again one error which has been there in the financial statement. So if you see, all the line items had some or the other error, and as most of you rightly spotted out, most of it was regarding non-compliance with the accounting standards. So I presume, considering lot of the members spotted this error correctly, you all have been following the accounting standard when it comes to your clients. Now let's move to accounting standard 2. Now this is a very, very basic accounting standard. All of us have learned this standard when we passed our CA exam, CA final. We would be again referring to this accounting standard as and when there is any situation which demands us to read through this accounting standard while applying this accounting standard on our client. Now why I have chosen this accounting standard is considering the recent scenario of COVID, considering this is a standard which is generally applicable on all of the non-corporate entities, I thought it would be relevant to have a recap, and then let's see some practical examples or difficulties or some complexities or some questions which we may come across while looking at valuation of inventory. So inventory is basically an asset which is held for sale in the ordinary course for production and in the form of material which would be or supplies which would be consumed in the production process. So it says inventory would be something which you will sell and earn revenue out of it. In the process of production, you hold any inventory that is again classified as an inventory. So raw material, WIP and FG are three classic, I would say, types of inventories which generally a manufacturing concern will hold. There's one more important aspect. Inventory do not include machinery spares. So there was a lot of discussion around whether machinery spares forms part of fixed assets or whether it forms part of inventory. And there was again an accounting standard interpretation issued, which says machinery spares should be accounted in accordance with the accounting for fixed assets or accounting for property, plant and equipment. So machinery spares generally, until unless it doesn't, I would say, meet the recognition criteria of AS 10, it will generally be part of your property, plant and equipment and not inventory. Now, how is inventory measured? We all know that inventory is measured at cost. So all purchase cost, all cost to bring that inventory to that specific location. So say, take an example, there's an imported inventory, there's a freight cost to bring it to the factory. All those costs are included as part of inventory. Again, cost of conversion. Cost of conversion includes all your direct overheads which you incur for converting that raw material into FG. All those costs are also forming part of inventory. So basically inventory is stated at cost, and when you decide what is the cost of inventory, it includes the purchase cost, conversion cost and all other costs to bring it to the present location. Now, how is inventory valued? We saw in the example, it was valued at market value, and most of you said that it is not a right way to value. So inventory should be valued at lower of cost or net realizable value. Now, market value and net realizable value is a bit different. Net realizable value is a selling price, estimated selling price. But in net realizable value, we also reduce the estimated cost of completion and estimated cost of selling. So take an example, you have an inventory, you expect that to sell that inventory, that inventory would be sold at 100 rupees, you will have to give a commission of 10 rupees to an agent to ensure that that inventory gets sold. So while considering the market value, 100 will be your market value, but when you will be computing NRV, 90 will be your NRV. So standard says that consider NRV, consider lower of cost and NRV while valuing the inventory. Now, when we say that inventory should be valued at lower of cost and NRV, that requirement applies to finished goods. So finished goods should be valued at lower of cost and NRV. What about raw material? So standard says whenever, so take a classic example that raw material in your books is lying at rupees 100. Today, raw material prices have gone down significantly for a particular item, and now in market, same item can be procured at say rupees 80. So now what will you do? Whether it will be lower of cost or NRV? So standard there says for raw material, which is used in the production process, you will not write down its cost. Okay, you will not bring it to the replacement value till the time the finished goods. So raw material is used in the production of finished goods. So you will not write it down till the time you are able to sell the finished goods above cost. So till the time you are making profit on selling of finished goods, you will not write down the raw material cost to its replacement value. That is what is the precise requirement of accounting standard. Now let's look at this case study. So A & Sons, it's a proprietorship firm which manufactures chips based on the orders received from customers. So they manufacture these electronic chips based on the orders received, and based on the below cost, please help me to assess whether raw material is required to be written down. So what we need to analyze is there is a cost of raw material which is given. That cost has reduced. So in our books, the cost of raw material on hand is 100 rupees. The current market value or the replacement cost of that raw material is 85. Whether you will write down the cost of raw material or whether you will not write down the cost of raw material. That is the scenario which we need to assess in this. So take 2 minutes, look at the slide, look at the values which are mentioned there, and using your chat box, you can type the answers. In case 1, what is your answer, and in case 2, what would be the answer? Anyone who could have completed case 1? So there are 2 answers to say. Case 1 should be at cost. There is no write down required. Case 2, valuation should be at replacement cost. So what would be the write down amount in case 2? Yeah, so I think there are few answers on the chat box. So in case 1, the answers are right. There is no write down required. In case 2, write down of rupees 15 would be required. So again, we looked at the principle. In case of raw material, if the finished goods in which those raw material gets consumed, if you are able to sell those finished goods above cost, then there is no write down which is required of a raw material inventory. So there is no write down required in case 1, as we are able to cover the cost of FG. So if you see, the cost of FG in this particular scenario is 340 and the NRV is 360. Okay, so we are able to cover. The selling price would be 370. So 340 versus 370, we are able to cover the cost. So no write down required. However, in scenario 2, a write down would be required, because we are not able to cover the cost in scenario 2 of an FG. Let's move to next question. Now, A & Sons is again a proprietary firm. It is manufacturing chips based on orders received from customers. Later on, customer cancels the order. So take an example. There is a proprietary chip concern. It has received a very big order from one customer to manufacture, say, 2000 chips. Later on, because of some reason, that order of electronic chips was cancelled by the customer. Now you are looking at the financial statements as on 31st March 2022, when that order was cancelled and inventory was lying in the books of that proprietary chip firm. What will you do with the cost of that inventory? Will you carry it at cost, or will you write it down? And what would be the consideration which you will give to while assessing whether it should be at cost or it should be written down? So if we look at the requirements of the standard very clearly says if that inventory could be sold in the market, if it is in a saleable condition, if customer is able to find a new, if the proprietor is able to find a new customer, then inventory can be carried at cost in books of accounts. However, if that was a very specific inventory or specific manufacturing made based on that specific order, and it is difficult to sell that inventory in the market, then we need to consider a write down of that inventory in the books of accounts. So there's no standard answer. It depends upon the facts and scenario. If a customer can be found, an alternate can be found, if it can be sold in the market, then there is no and that sale value would exceed the cost of the inventory which is there in the books, then no write down is required. If it was a very specific part which could be hardly sold in the market, or there would be a significant amount of rework which would be required before you sell it in the market, then so in certain cases it happens that there was a very specific order which gets cancelled, and now to make that specific electronic component into a general component, there would be additional cost which would be required to be incurred. Then what you need to do is whether that additional cost which is expected to be incurred should be accrued or accounted in the books of accounts. That is what you need to assess. Another example, A & Son had shut down the manufacturing plant temporarily for 2 months due to fire. On account of the lower production, all under-absorbed overheads were loaded on inventory. Is this accounting treatment appropriate? So on a lot of our clients, we would have seen during COVID times, there was a lot of shutdown which had taken place. So a lot of client had attempt to load those overheads on the, load all the overheads on the inventory which is lying. So what do you think, whether it is appropriate to load all the under-absorbed overheads on the inventory? What would be the appropriate treatment? Any guesses, any answers in the chat box? So Jitesh is saying, no, you can't load it. Abnormal cost cannot be loaded on inventory. So it's a very valid point. Abnormal cost cannot be loaded on inventory. Overhead absorption or overhead loading on inventory should always be based on normal production capacity. Okay, so considering the normal production capacity only, overhead should be loaded. Any abnormal cost, because it was not absorbed, it should not be loaded on inventory. So this was a quick recap about the accounting standards on inventory. Now let's move into the requirements of accounting of property, plant and equipment. So we used to generally call it as fixed assets. So most of you would have would recollect this reading as accounting of fixed assets. So few years back in 2017, Institute has revised this accounting standard, and accounting of fixed asset was changed into accounting of property, plant and equipment. Though large requirement do remain same, but there are certain changes which were brought into this standard in 2017, like revaluation model, etc. However, large principles of this accounting still remains same. So what is property, plant and equipment? Property, plant and equipment is an tangible item which is used in the production, okay, and which is expected to be used for more than 12 months. So basically, it's an asset which you use to produce goods or services. So what are the key principal issues which are generally faced when we account for property, plant and equipment? So there are 4 type of principal issues which are generally dealt by this accounting standard, which talks about recognition of PPE. How should property, plant and equipment be recognized? How it should be measured? At what value it should be carried? How should depreciation be charged? So as I already mentioned, AS6 is not there in place now. So accounting standard 10 also covers the depreciation aspect. And then there is another aspect which talks about impairment losses to be recognized in relation to these assets. Okay, so 4 key principal issues are recognition of PP, determination of their carrying amount, depreciation and impairment losses. So let's look at the recognition criteria. So when is an asset recorded as a property, plant and equipment? A cost of an PPE should be recognized as an asset only if it is probable that there will be future economic benefit which an entity will get out of that PPE, and you can measure the cost. So suppose take an example of a machinery being purchased. So if it is probable that using that machinery, the proprietor will be able to produce the goods and sell those goods. So there would be future economic benefits in the form of revenue from sale of those goods which will arise, and therefore it is probable that there are future economic benefits associated to it, and you can obviously measure the cost of that machine reliably. Only then you will record that as an asset. Okay, so when there is a future economic benefit and cost can be reliably measured, an asset should be recorded as PPE in the books of accounts. Now what happens is, say initially there was a machinery which was bought. We can assess the definition and say that, okay, it will be used in the production of goods and services and we will capitalize it as machinery. Now there are some repair work which is done on that machinery subsequently. Because of some breakdown, there was some repair overhauling required for that machinery. What will you do? So standard says subsequently also you need to apply the same criteria. Because of that repair, if there would be a future economic benefit or increase in the life of that machine, then you could capitalize it, else it should be charged off. So generally what says, very major repair and overall expenses, can be capitalized, else it should be charged off. So I'll give you an example of a aircraft. Okay. Now suppose in an aircraft, after a few years, there is a need to change the airframe. Okay. Now and there is a mandatory repair and overhauling work which is required to be done. Okay. Now that major repair and overhauling increases the future economic benefit and the life of that asset, of that aircraft, then standard does allow you to capitalize. Else it says any normal repair or maintenance expense which you incur on an asset should be charged off to P&L. Now what are the measurement criteria? So this is about recognition. So this talks about when you recognize what all factors you need to assess. And subsequently, if you incur any expenditure, again, you need to go back and see whether there is any future economic benefit which will flow because of this expenditure. So this was about recognition criteria. Now let's come to the measurement criteria. So when you buy a plant and machinery, how will you, at what value will you record it? Okay. So plant and machinery on initial recognition or any asset on initial recognition should be measured at cost. What is cost now? Again, all the direct costs which were incurred to bring that asset to its specific location, all those direct costs can be considered as cost, and can be capitalized. So let's look at what is generally a cost for a property, plant and equipment. It says all purchase price, all duties, all non-refundable taxes. So suppose if you pay GST, which is for which a credit is not available, you capitalize that as a part of property, plant and equipment. Suppose if you pay some import duties for which credit is not available, again capitalize it. Suppose you get some discounts, then this discount should not be considered, should not be capitalized. So you will take that benefit of discounts. Any other cost, say freight charges incurred, consider that. It again, this standard also talks about this decommissioning restoration liability. Now, what is decommissioning restoration liability? So standard says when you buy an asset, okay, if you can estimate initially that when you will remove this asset and you will restore the size as it is. So suppose take an example of a leasehold land. When you take a land on lease, okay, after 99, you set up a factory there. After 99 years, so generally say leases are for 99 years. If you have to give back that land, you will have to demolish the entire factory. Okay, for removing that entire factory, you will incur some demolition cost. If you can measure that reliably, okay, on day one, consider that also as a part of property, plant and equipment and create a provision for it. Okay, now practically this is largely not done, considering it is very difficult to estimate what would be the value of decommissioning, restoration and similar liabilities. And also generally agreements do have clauses which talks about renewal. So this is practically not generally followed, but yes, there is a decommissioning restoration. There is a lot of guidance on this regarding how to measure and how to assess these liabilities. Largely what we need to remember is when you measure the cost of PP, consider the purchase price, consider all non-refundable taxes and all direct cost which is attributable to bring that asset to a particular location. Now this is about when you measure the property, plant and equipment initially. What about subsequent measurement? So standard says there are two types of model, cost model and revaluation model. Okay, so on day one, I measured the machinery at cost. Subsequently, I can measure that at cost or I can do a revaluation model. I can follow a revaluation model. Okay, that's an accounting policy choice which has been given under this accounting standard. However, one needs to keep in mind that when you are doing a revaluation, entire class of asset needs to be revalued. So take an example. If you have decided to revalue building and you have 10 buildings, then all those 10 buildings need to be revalued. You can't pick and choose one or two buildings. Okay, so entire by class, you can decide that for plant and machinery, I will go for cost. For buildings, I'll go on a revaluation model. But then entire asset block of building needs to be revalued. That is the requirement of the standard. Now let's look at some case studies. ABC and Company, it's an LLP, has incurred 1,000 rupees towards advertisement of the new product. ABC and Company believes as sale for the new product has just begun, this cost should be capitalized at part of PPE of the plant and machinery for manufacturing this product. So take an example, ABC and company is a LLP. It is starting a new product line, okay, for which it buys new machinery, new assets. Now, till the time the revenue is yet to begin, company has started doing some advertisement, and company is also incurring, say, some launch cost for launching this product. Now there's no revenue from this product. Therefore, company believes that we should capitalize this cost as part of PP. What do you think? Whether the standard allows it? Any answers there? Sorry. So anyone would like to guess any answers on chat box? No, not can't be capitalized. So there are a couple of no's which have come up to say it can't be capitalized. So yes, this cost can't be capitalized because only if we go back and look at the definition of cost, you can capitalize the purchase price and direct cost to bring that asset. This is an indirect selling overhead which can't be capitalized. So you will find such type of arguments come up practically when there are new products issued, huge expenditure is incurred by the clients. So we should keep in mind what can be capitalized and what can't be capitalized. We do face problems around repairs and maintenance, where on certain aspects, client says that this should be capitalized. This is increasing the life of asset. So always keep in mind that if it is a very major inspection, rehaul expenditure, only then it should be capitalized, as generally repairs and maintenance doesn't increase the life of asset and should be charged off. Now let's look at the next question. ABC and company has 4 freehold land in the class of freehold land. It has decided to revalue 2 land out of the total land class, whether it can revalue part of class of asset. So it has 4 land. The proprietor knows that for 2 land, there is a significant jump in the value. The proprietor wants to avail a loan and therefore wants to revalue those 2 lands. And he has come to you to say, I will adopt a revaluation policy. I will revalue my 2 lands. Whether you will allow him? So answer is no. All 4 lands should be revalued. So again, from a revaluation perspective, the standard is very clear. Entire class of assets should be revalued. Otherwise, what will happen is non-corporate entities will start revaluing as per they will start doing pick and choose and revaluing as per their whims and fancies, because that may lead to significant improvement in their balance sheet, which may help them from a financing perspective. So it says, once you follow a revaluation model, follow it for the entire class of asset, be it upward revaluation or be it downward revaluation. Also keep in mind, once a revaluation model is followed, the revaluation needs to be done generally at least at every year end, in case there are reasons to believe that there is no material change in the value of that assets. And generally see that a registered valuer or a third party valuer is involved when revaluation of asset is significant and has been done by the concern. Let's look at the depreciation aspect. I think this is very, very important. So what does the accounting standard talks about depreciation? So accounting standard says that when you depreciate an asset, there has to be a useful life of asset which should be considered. So based on management's assessment, or I would say the generally practically we see that it is very difficult to technically assess the life. So what do people do? They look at Schedule 2 rates. Those Schedule 2 rates are not applicable or indicative and more relevant from company's perspective, but a reference can be drawn from those rates, and obviously income tax act rates also can be referred to in case there is any other reference point based on which life can be determined. That reference point can also be used by the concern to determine the useful life of assets. So it is very, very important that useful life of assets is considered while charging the depreciation. These again, the standard talks about different methods of depreciation, which include straight line method, WDV method, output method. So those methods remains as is. Those were there in the earlier AS6 as well. So again, there is a policy choice to say straight line method or WDV method, whatever. Those are the common prevalent methods which are followed by the assessees. in computing the depreciation. Now, component method of depreciation. What is this? So it says that suppose if you have a big asset, there are different components in that asset. Now again, take an example of aircraft. Okay, there is an airframe there, there is engine there. Now, if the value of airframe is very significant to the value of the total aircraft, if the value of engine is also very significant to the value of total aircraft, how do you determine whether it is significant? So standard doesn't talk about how to determine, but generally 10% is considered to be a indicative measure to say it is significant. So say in aircraft value is 1000 crores, airframe value is 100 crore. Okay, so it is significant. Now suppose life of airframe is different than life of engine. So it says that the component of asset should be identified and depreciated separately when it is a significant component. So say airframe life is 10 years, engine 15 years. So airframe should be depreciated over a period of 10 years, while engine should be depreciated over a period of 15 years. Generally, you will be seeing that total entire aircraft will be capitalized and one asset useful life will be assessed. But ideally, from an accounting standard perspective, that's not the ideal way to do it. It says, look at the components also, if there are significant components there and they have different useful life. If they have same useful life, then there is no issue. But if they have different useful life, then you should consider that different useful life. Okay. Depreciable amount. So depreciable amount is cost of asset minus residual value. Residual value is value which you will recover when you sell that particular asset. So these four aspects are very important from a depreciation perspective. Now let's look at a practical issue. Now a client comes to you, say ABC and company, it's a proprietary concern. It wants to, till last year, it was following a straight line method of depreciation. This year, he is approaching you and telling you, I want to follow a WDV method of depreciation. So whether a concern can change the method of depreciation? If yes, whether it is an accounting policy change or an accounting estimate change. What is it? I'll tell you why it is relevant. If it is accounting policy change, it needs to be done retrospectively. If it's an accounting estimate change, then it needs to be done prospectively. Prospective means going forward. Any guesses whether he can change the method of depreciation and whether it should be an accounting policy or accounting estimate? So there are a couple of answers on chat box. Jitesh says it's an accounting estimate. Madhu says it's a accounting policy. So if you again go back and look at the AS5, so this is there in accounting standard 5, it says it's a change in accounting estimate and should be accounted prospectively. So till last year straight line was followed, from the current year WDV can be followed. It is change in the accounting estimate and not an accounting policy. Look at the next question. ABC and company wants to use income tax rate of depreciation for charging depreciation in books of accounts. Whether they can use same rate of depreciation in both the books. I think we discussed this already. Any answers? So your client says, I want to use same rate, same life, same rate of depreciation. So income tax doesn't have a concept of life. There's a rate of depreciation. He wants you to use same rate in books of accounts. So whether they can do that. Any guesses? No answers on chat box. There's one yes which has come up. So Vicky Birla sir is saying yes, we can do it. Yes, the answer is yes. The client can follow same rate of depreciation. However, what you need to keep in mind is under Income Tax Act, a WDV concept is followed, wherein a block of asset concept is being followed. Same concept you can't apply in books of accounts. So in books of accounts, as per the method of depreciation which is adopted, you need to accordingly capitalize the asset and charge the depreciation. Rate can be seen for both the books of accounts. So this was all about accounting standard 10. Let's quickly move to accounting standard 9, which is regarding revenue recognition. Now, AS9 is always critical because revenue is the biggest or the I would say the most important line item in any financial statements. So let's try and quickly look at what are the requirements of AS9 and then one or two practical case studies around it. So accounting standard 9, which is revenue recognition, generally covers revenue from the course of ordinary activities like sales of goods, sale of services, and use of resources like interest income, royalty, dividend are also covered by AS9. It doesn't apply to government grants, leases, that those are covered by separate accounting standard. Now, what is revenue? Revenue is inflow of cash, receivable or consideration, which is arising because of sale of goods or services or rendering any services, okay, and which can be reliably measured. Okay, so what is revenue? It is inflow of cash, which is arising during the period from your sale of goods or rendering of services. One more critical aspect which you need to keep in mind here is in case of a revenue, in case you are an agent, okay, take an example. You are selling tickets, airline tickets, and you are a commission agent wherein the airline owes the ticket, you are just facilitating that sale. Therein, revenue is the amount of commission and not the gross inflow. So, say ticket value is 1,000 rupees and your commission out of that 1,000 rupees is 10 rupees. So, for that entity who is acting as an agent, revenue will be 10 rupees and not the 1,000 rupees. Okay. So, these are the basic definitions about revenue. Now, let's discuss about a very practical question. Whether GST collected will be disclosed as a part of revenue. If yes, why? And if you know, why? So along with yes, no, you need to also give a very brief reason to say why you believe it should be a part of revenue or it should not be a part of revenue. If you recollect, when we used to collect the excise duty, we used to show that as a part of revenue and then again reduce it to and disclose it separately to show, say, less excise duty. So for GST, what are we required to do? It should be part of revenue, it should not be. So it's a GST is a tax collection on behalf of government, correct? Even excise duty was tax collection, but we used to gross it up and then say less excise duty. Any reason you think we used to do that? So I'll tell you, there was a separate ASI interpretation and there was a separate guidance because of which excise duty was required to be grossed up and shown separately as per the accounting standards. Since it's a collection on behalf of customer, it is not gross inflow which is flowing to you because of sale of goods or rendering of services. GST should not form part of revenue. So you will not gross up and say less GST. You will not include GST at all. Now let's look at the timing of revenue recognition. I think in the revenue standard, what is very, very critical is when should revenue be recognized. That is the most critical aspect. So standard says revenue should be recognized when all three conditions are met. What are those three conditions? Transfer of property in goods to the buyer, or we say when significant risk of and rewards of ownership are transferred. Okay. So suppose you sell goods and the ownership or the title of goods is yet to be transferred. So then that would not warrant a recognition of revenue. So for recording a revenue, there has to be transfer in the property of goods or services or the significant rewards. So even in case there is no physical transfer because of some reason, significant risk and rewards of ownership are required to be transferred. And seller has no control over those goods and services. So that is the first criteria, which is transfer of property. Second criteria is no significant uncertainty is there around the amount of consideration. So when you are recording a revenue, you should be very sure that you would be able to collect the entire amount and the amount is collectible. There is no uncertainty on the total amount to be collected as well as the timing of its collection. So basically, you are sure that you will be able to receive that amount from the customer. In case there is uncertainty or you don't expect that collection to happen, then revenue should not be recognized. So revenue should be recognized when you give away the ownership or risk and rewards, when there is no uncertainty regarding what is the amount of consideration which I will get or what is the amount which I will receive. and you can expect that the party will pay to you. If all those three conditions are met, then you should record the revenue at that particular point in time. In case of, so this was regarding goods and services. In case of service contracts, there are two methods which have been prescribed in the standard: proportionate completion method and completed service contract method. Now, what is proportionate completion method? I'll give you a simple example. Say in case of, I would say in case of tuition fees, okay? The tuition fees of a particular class is say 1,000 rupees, and over a period of time, there would be 10 lectures which would be done. For a person to recognize revenue, for the person who is taking tuitions, for him to recognize revenue, he should follow proportionate completion method. So as and when he delivers a lecture, one milestone is automatically met, and therefore he can follow a proportionate completion method to record the revenue. Now, what is completed service contract method? In case when you are delivering a service and there are hardly 1 or 2 milestones, and those milestones, or I would say the end milestone is the most significant one, and because of which service can't be completed, then you record the revenue using the completed service contract method. So take an example of an ad agency. In case you pay any commission to an ad agency who will facilitate you for an advertisement in newspaper, so he will record the commission, or he will record the revenue from the services only when the ad is printed in the newspaper. Vis-a-vis for tuition, as and when lectures are delivered, the tuition owner could decide to recognize the revenue. In addition to that, those two conditions remain same, that there should not be uncertainty around the amount, and it should be expected that you will be able to collect that amount. Only then revenue should be recorded. Now, what happens? Suppose in your client records a revenue of 100 rupees in this year. Until next year, he has not been able to receive that amount, and he believes that he may not be able to receive. What will you do? Will you reverse that entire revenue, or will you create a provision for doubtful debts? So standard says that create a provision. If there is a revenue which you had already recorded, and because of there is some uncertainty, now you believe that you will not be able to get it, create a provision. Don't reverse that entire amount in revenue. Now take a scenario. This year your client has sold some goods, but he is not very sure, because it was a sale to say government entity. He is not very sure whether he will be able to receive that amount. So because there was no certainty of collection, client did not record the revenue. You didn't ask him to record the revenue. So revenue recognition was postponed. In the next year, he gets the money from that party. Now what will happen? You will record that as revenue in the current period, because the conditions were met in the recognition condition of certainty around collection was met in the current year, and therefore you will record that as revenue for the current year. So it forms part of your current year revenue recognition. So what are few key considerations which you should keep in mind while recognizing revenue? Cutoff procedures. What are those cutoff procedures? There's a lot of discussion around cutoff procedures. This is more of an auditing angle, I would say. So whenever there is a cutoff period, say 31st March. So take an example, your client had sold the goods. There is a proprietary concern. He has shipped the goods to his customer. As per the terms of the sales order, the terms of the sales order says that the client should deliver, your client should deliver the goods to his customer at his doorstep. Till that time, all the expenses, all the risk, everything is of your client. So basically, we are saying significant risk and reward will transfer when those goods are handed over to the customer by your client. Now on 31st March, you are doing your audit. You see that on 31st March, the client has dispatched the goods, but those goods were not received by your customer. He received them on say 15th April. Because of some reason, there was delay in shipment, and then that person received those goods on say 5th April, 10th April or 15th April. Then the date is not very relevant here. What will you do? Will you ask your client to postpone that revenue recognition, reverse that revenue recognition, or will you allow the client, because physically he has already transported the goods, you will allow the client to go ahead and book the revenue? Any idea or any guess which you want to do? Practically, what will you do? Will you ask him to reverse and postpone it, or will you allow him to book it? Any guess? Anyone who would want to try on chat box? So basically, in such scenario, you will ask client to few answers I have got is booked in current year. Okay, no, if risk and rewards have been transferred, transfer of physical property is irrelevant. So I think this is very valid point. Accounting standard says risk and reward should be transferred. Now in this particular scenario, because the terms of sales order says that all the risk and reward will transfer when the customer of your client will receive the good at his end. Okay, so those are door delivery terms. When he receive it, only then he will take all the risk and reward pertaining to the goods. Then in such scenario, you should postpone the revenue. You should not book the revenue. Now there are very practical challenges which comes across. How do you assess whether risk and rewards have been transferred? Okay, so the simple 2-3 test, though it may sound to you to be impractical scenarios or may not be very daily scenarios, but these are the tests which you do to see whether risk and rewards have been transferred. So take an example. If anything happens during the shipment to the good, during transportation, if goods are damaged, whether the customer will take the responsibility of the goods or whether you will have to, your client will have to reimburse, will have to take the responsibility of the damaged goods. Who will do that? Who will bear the cost? Who has taken the insurance? I think those are the considerations which are very deeply looked into. Generally, what you should keep in mind, whether then there are other aspects also which are considered, like whether your client can direct the goods to some other customer midway. Okay, so say your client has sold the goods to ABC Limited, but in between D Limited said, I'll pay you more price, I need it urgently. So rather than delivering it to ABC, he transferred it to D Limited. That means he had that authority on the goods to transfer it somewhere else before the goods were received to that customer. That again gives you an indication that risk and rewards were not transferred. So all these practical aspect needs to be considered to assess whether risk and rewards are transferred or not. And then revenue recognition should be considered. This is a typical issue which we generally face when we do audit of revenue at the year end. So these are more of year end related issues where goods are shipped, goods are not shipped. They have just been shipped on 31st March to book the revenue in a particular year, or many of the clients may not want revenue because of tax liability coming up. So they may have goods which are sold, okay, but they are still lying in their premises. They will ask customer, "आप next year 1 April को लेके जाना." However, those goods are not yet built, but those are ready, kept separately, identified. So such type of issues are there. Practically will always emerge. So what you need to do is you need to look at the substance over form of the transaction and you need to assess whether risk and rewards have transferred. So physical delivery is not so important. Risk and rewards is something which is important to decide whether cut-off procedures require a reversal of recognition or reversal of revenue or recognition of revenue. What about trade discounts and volume rebates? This should be reduced while recording the revenue. Another key consideration while recording revenue is guaranteed sales. What is guaranteed sales? So suppose in case of retail, this happens that there is a guarantee which is given that if you are not satisfied with the quality of the goods, you can at any point in time take your money back. It's like a money back policy. You can take your money back and you can return the goods. So what will you do? In this case, there is a window which is open. That window at times could be a very big window, maybe unlimited window also to return the goods, or maybe 2 months, 3 months, 5 months window. What will you do? Will you wait till that window gets over and then record revenue, or will you record revenue as and when you sell those goods? What will you do in this particular scenario? Any guess? So you have sold the goods, say retail goods, with a money back policy. If you are not happy with the quality, bring back the goods in 3 months, we will pay you back your entire amount. What will you do? You will record the revenue today, or will you wait for 3 months to get over? Any guesses? So Jitesh is answering here to say record revenue and create a provision based on past experience. Abhishek is saying record revenue. That's a right answer. So standard says yes, record revenue and create a provision based on past experience. Now, because there's a window open, however, risk and rewards have been transferred regarding those goods, you expect a collection also of those goods. It says you can go ahead with revenue recognition, but create a provision for sales return based on your past experience. And also it should not be a consignment sale. Consignment sale is a different sale. We will see that practical example in the next case study. So if it is a consignment sale, then you don't record the revenue. In case it's a direct sale to a customer with a money back period, you can record a revenue with a provision being there. What is an installment sales? Installment sales is, suppose you sell a particular thing on installment and you are charging interest. Okay. Now the question here is, what will you do of that interest? Whether that interest you will record today as revenue, or only you will record that interest over a period of time as revenue. So that interest income will also form part of your revenue, but it should be recorded over a period of time as and when it becomes, that interest income becomes due. So interest income should not be recorded on day one. Let's look at some practical cases. XYZ and Company LLP has manufactured goods which were delayed for delivery at the customer's request. Okay, so there were goods which were manufactured. Your client wanted to ship those goods before 31st March 2021. But the delivery was delayed because customer said, I have some issue at my end. Please do send it now. Send it in the first week of April. Now your client wants to take a loan from bank. He wants to show his good results. He has come to you and said, I want to record this revenue in this year itself. What will you do? Will you allow him to record revenue? And whether standard principles set in the standard will allow him to record this revenue? What would be your suggestion to your client? Will you allow him? Will you not allow him? And why? Any suggestions on chat box? So basically, standard says physical delivery of goods is not so relevant. In case significant risk and rewards are transferred, then you can allow the customer to, you can allow your client to record the revenue. Now, how will you decide whether significant risk and rewards are transferred? Goods are lying at your premises. So suppose your client doesn't have right to sell these goods to some third party. Okay. Generally in practical scenario, people from a documentation perspective, people also have those evidences to say the customer has requested me to hold on his behalf, which is typically called as bill and hold sales. So you bill it, but you hold it and keep it at your end, and your customer acknowledges that I am the owner of these goods. I have asked you to keep these goods in your premises on my behalf. In such scenarios, revenue can be recognized. In case risk and rewards are not transferred, so in case there is no sufficient documentation, there is no intent, substance over form. If you look, there was no intent of this sale being taking place. It is just a manual billing. Then revenue should not be recognized. Okay. In the next point, again, if the buyer is willing to take the title and accept billing, should revenue be recognized? Again, same principles will apply, whether risk and rewards have been transferred or not. Look at the next example. XYZ and Company LLP has delivered the goods to his customer. So they used to, XYZ and Company LLP, again your client, it is in the business of manufacturing, say, plant and machinery. Now, plant and machinery is required to be installed also at the customer's premises. However, that installation and inspection of good at the customer end is pending. What will you do? Will you allow recognition of the goods or revenue from the sale of goods, or will you ask your client to postpone till the time installation takes place? What will you do here? So he has sold the goods have been dispatched, but installation is yet to be done. And installation is very critical. aspect of this sale. So in case installation is very important step, he can't book a revenue. But suppose installation is a mere formality, inspection of goods is a mere formality at customer end, then revenue need not be recognized. So what needs to be looked into is whether it is very critical, then revenue should be recognized. If it is a very critical step in the entire contract, then it should not be recognized, else it can be recognized. Look at next example. XYZ and Co LLP has manufactured goods and sold it to the agent who will sell it to the end customer. Now agent has right to return the goods if those are not sold. What will you do? Whether you will recognize the revenue. So here what has happened is there is an agent whom your client has appointed. Your client has sold the goods to the agent. Okay, but there is a condition that if agent is not able to sell those goods, your client will take back those goods. So this is typically called as consignment sales. So in such scenarios, sales are generally recorded when sale will happen to the third party. Means when the agent will be able to sell these goods to the end customer, in that scenario, in such scenarios, revenue would be recognized at that point in time. Okay, because agent is just holding those goods on behalf of the XYZ and Co LLP. Now take an example in the above scenario, whether an answer would change if there is a time period of say 7 days to the agent to return back the goods. After that, XYZ Limited will not take back those goods. They will not accept any return of sales. Okay, whether your answer would change. Yes, the answer would change. So in case there is a say very limited window of say 7 days, it is then not a consignment sale. Basically, it's a sale. The agent is actually a customer for XYZ and Co LLP, and therefore XYZ and Co LLP can go ahead and start recording revenue for that as and when sales takes place, as sale has actually taken place to a customer, and he doesn't assume any liability if the agent is not able to sell it further. So here there is rather than an agent principal relationship, it is more of a customer to customer relationship which is there, and therefore revenue could be recognized. So largely with this case studies, it brings us to the end of today's session. And I would happy to take in case there are any questions, any members have any questions around our today's discussion.
Thank you so much, ma'am, for the session. It was really informative, and I'm sure it will help all us members in our audit.
Any questions? Or you can later on also, in case required, let me know in case there are any questions. I will be happy to take any questions offline as well. Okay. Before we end this, I will also just highlight that what I have done is I have included an appendix. So when we were discussing about, since we have time, we were discussing about the applicability of the accounting standards. What I have done is I have included an annexure wherein standard by standard applicability is mentioned. So like AS1 is applicable to all entities. AS3 is not applicable to any of these entities. AS10 is applicable with disclosure exemption for level 3 entities. For level 2 entities, it is applicable. For level 3, it is applicable with disclosure exemptions. So there's a separate annexure. Please go through that annexure in detail, because whenever you will be assessing the applicability of level 2, level 3, level 4 on your clients, this will be very relevant to decide what should be given as a disclosure in the notes to accounts, in the financial statements, and what all exemptions could be available. There are a lot of exemptions which Institute has given, and if read appropriately, the entities can benefit from it. They may not disclose whatever is not required. Plus, what I have also included is standard by standard, whatever exemptions are there. So one is disclosure related exemption, and for few standards, there are transition provisions as well as additional exemptions which are given. Those are also included as part of annexures. So I would request all the members to consider this when you would be assessing on your clients the applicability of the accounting standards. And as a closing remark, I would want to again re-emphasize the importance that we as a members of Institute of Chartered Accountants of India, it is very important that we follow the accounting standards while doing all our attest related function, even if those are non-corporate entities. The current regulatory environment is becoming very, very strict. Every day there are new regulations which are coming up. Disciplinary committee of institute has become very, very active. Hence, it is very important that we are duty bound to follow. We as professionals and members of institute are duty bound to follow the standards, and we should follow them in true spirit and ensure that we are safeguarded against any of these actions. So tomorrow, in case any of your client is picked up on any quality review by the quality review board, your quality of tax audit should not be questioned, and your quality should be up to the mark, and therefore it is very important that we should follow all these relevant standards. This brings us to the end of the session, and thank you so much for being a patient audience and for giving me this opportunity. So I would like to thank all the three branches, the chairman of all the three branches, and Saurabh Ajmera sir also, for giving me this opportunity to have this session with you, with all of you. So I really enjoyed doing it. Thanks a lot.
Thank you so much, ma'am. It was really a great session, and I'm sure this is going to help us in our future audits. Presently, I don't see anyone has raised any question.
Yeah.
Just, I guess, Hukum Chand Jain sir had raised his hand. I'm not able to see his name.
Please unmute him.
Yeah, I'm just trying. Just let me type. No, he's not there in the webinar, unfortunately.
Yeah, I guess he left.
Yeah, I guess that. Yeah, he's there. So once again, thank you, ma'am. And now I would request C. Abhishek Kothari sir, Secretary of Jalgaon branch, to give closing remarks and vote of thanks.
Thank you. Regarding closing remarks, I will say in last few minutes, ma'am has already repeated everything. The closing remark is actually what I was planning to give. Ma'am, you took lecture with, it was very interesting lecture. You made it interesting and light by taking practical example and asking us to involve and answer. So being interactive, we enjoyed it and we learned the practical scenarios. And definitely this session will help us to improve our reporting and the statutory work which we do. So the standards need to be followed. And as there is so much fuss going about the work, so quality is more and becoming more and more important. So this shall help us in improving quality, be it on standard easy topics like revenue recognition or recognition of closing stock or inventory. So I would like to thank you, ma'am, for delivering this wonderful session. Thanks to Saurabh Ajmera sir, ICM Saurabh Ajmera sir, for being here with us and helping us in arranging this session. Thank you to Pawan sir from Chairman Ahmednagar branch, Pawan Jaju sir, Chairman Amravati branch, my Chairman C. Vicky Vilas sir, Chairman Jalgaon branch, MOC Jitesh sir for successfully helping in arranging this session, and thanks to all three branch managing committees, to all the attendees for being with us during this session and enjoying this session. And thank you very much.
Thank you, sir. Well, I guess now this brings us to the end of today's webinar. Again, thank you so much, everyone.